Have you ever wondered how much of a home you can afford before speaking to a mortgage professional and having your credit run? Well, by the end of this video, I'm going to tell you exactly how mortgage companies calculate your debt ratio so that you can figure out how much of a home you can afford before speaking to one. And all you need is a piece of paper, a pen, and maybe a calculator. In order to figure out how much of a mortgage you can afford, mortgage companies are going to use a tool called the debt ratio. A debt ratio is just a very simple formula that is debt divided by income. So for example, if you have $2,500 a month in recurring debt and you make $5,000 a month in income, your debt ratio would be 50%. To simplify this even further, what this means is for every dollar you make, 50 cents is going out to debt. Now, the mortgage industry will typically approve mortgages under a 50% debt ratio. There are some exceptions where we can go over, but most of the time we want your debt ratio at maximum 50%. However, for the purposes of this video, we're going to use 45% as our debt ratio. The reason for that is most conventional mortgages will approve you up to a 45%, but understand that there are some situations with other factors that will allow us to go up to 50%. So let's walk through an example together to make sure that you got it. On the income side of the equation, I want you to write down $10,000 a month in household income. $10,000 a month is a nice, easy number for us to work with. On the debt side of the equation, I want you to use $500 a month for a car payment, $300 a month for credit card debt, and $200 a month for a loan, like a student loan or a personal loan. If you add all that debt up, it's gonna come to $1,000 a month. So right now, before the mortgage, you have a debt ratio of 10%, right? $1,000 a month divided by $10,000 a month in income. Okay, it's a nice low debt ratio, but we haven't plugged in the mortgage yet. So to figure out what the maximum amount of a mortgage we can qualify for, we're gonna take $10,000 a month in income and multiply it by 0.45. Remember, at the beginning of this video, I said that the mortgage industry typically likes to keep your debt ratio under 45%. So 45% of 10,000 is $4,500. You then deduct the $1,000 a month you already have in recurring debt, which leaves you with a maximum available mortgage of $3,500. So now you may be thinking to yourself, okay, I figured out how much of a payment I can qualify for, but what does that mean as far as a mortgage loan? How much of a loan can I qualify for? And the easiest way to figure that out is to go on my website. Under mortgage tools, there's an affordability calculator where you can plug in exactly how much of a mortgage payment you're looking for, and it'll tell you what that equals as far as a loan amount at today's interest rates. The other way is you could reach out directly to me and I can help walk you through it and calculate it for you. Thank you so much for watching. Please give me a thumbs up, hit subscribe, and I'll see you on my next video.